Good morning, everybody. Thank you very much to Breakbulk for asking me back again to give our latest outlook for the multipurpose and heavy lift fleet. It's taken from my latest report for Drury, which was published just 2 weeks ago, actually, so it's all brand new information. We're going to have a look at the fleet composition, we're going to look at the cargo demand for those vessels, look at the pressures on the supply-demand balance, what affects those rates going up and down, and I'll finish off with my outlook in a very general terms and obviously with a lot of caveats. So, vessel supply. As of the 1st of September, there were almost 3,200 vessels that were classed as multipurpose and heavy lift. That is, they have the ability to carry both breakbulk and project cargo in a variety of modes. The combined deadweight for that whole fleet is just over 29.5 million DWT. Within that number, there are about 900 ships that have a capability of over 100 tons. We classify those as project carriers. And of those, about 350 have a capability of over 250 tons. So they're our premium project carriers. As you can see, most of those vessels are the brown, and it's a sort of a light blue at the top of those columns. Most of those are over 10,000 deadweight. Just a little look at the age profiles, because it's a really fragmented fleet in terms of vessel design, and they broadly fit into 4 categories. So there are 1,400 ships that are classed as multi-purpose but don't have their own cargo. And I know don't have their own gear, don't have their own cranes to carry that cargo. So the vast majority of them are under 10,000 deadweight. The vast majority of them trade short sea, but they do carry both breakbulk and project cargo. And until I can split that demand up, they have to sit in this fleet. So that's where they are. They're the top left-hand graph there. They have an average age of about 18 years. There are 780 ships, top right-hand graph, that are that have their own cranes, but a lift less than 100 tons. They have an average age of about 22 years. They're by far the oldest section of the fleet. They're not all short sea. Some of them are long-haul vessels, so just be aware that there is that section there. 560 vessels, bottom left-hand corner. 560 vessels, project carriers with a lift of between 100 and 250 tons, average deadweight of about 14,000, and an average age of 14 years, so slightly younger. By far the youngest section of the fleet, bottom right-hand graph, premium project carriers, lift over 250 tons. They have an average age of about 10 years and an average deadweight of about 16,500 tons. So the current order book contains just 53 vessels, combined deadweight of less than 500,000 DWT, and represents less than 2% of the operating fleet. It's a tiny order book in terms of the maritime sector. You can see from the graph that there are slightly more non-heavy lift capable vessels in that order book. It's quite difficult to split the order book any more than heavy lift capable and non-heavy lift capable, because when you get a new order for a ship, as if you're not the owner, then you only see whether it's heavy lift. You don't see what the actual capability is. But anyway, up until about a year ago, that position was reversed on the order book. We had a position where we had at least 60% of the order book was heavy lift capable. Investment has dropped so much that we've now slightly reversed those positions. Anyway, when we assess that order book going forward and we look at the fleet development, we also look at the slippage levels. So that is the number of vessels that were actually delivered compared to the number of vessels that we thought were going to be delivered. So 2018, that slippage level was at 60%. So that is only 40% of vessels due to be delivered in 2018 actually made it out onto the ocean. Okay, and over 2019, that level's been maintained. It's running at about that. It's not clear whether that's because owners are pushing back those few new buildings that they have because the market's so low, or whether it's yard delays. But it is clear that slippage levels across the maritime sector, whether you're talking container ships or tankers or project carriers, slippage levels are a similar level. So we also look at demolition. Demolition has been on the decline for the last few years. 2018 was a historic low. The light blue on that graph, the key on the right is incorrect. The light blue is our forecast for demolition, not total. It's our forecast for demolition. We do expect demolition levels to rise from 2020 onwards, mainly because of increased environmental regulations, although IMO 2020 has had no impact on demolition levels yet. And it's possible that that 2019 column could be hope over experience, really. Anyway, if we look at both those sides, so new buildings are above the zero axis, demolitions are below. You get a fleet development as shown. All the growth is in the project carrier sector. There's about 1% growth in that fleet over 2019, compared to that similar contraction in the non-heavy lift capable vessels. So going forward over the next 2 years, we see a stagnating fleet effectively. It's about level. The decline is something like minus 0.1% per year. So it's a fairly stagnating fleet. As I say, in my report, we look out to 5 years and we make some assessments going forward, but it's a very low level of growth, if anything, after 2021. So what about the cargoes that those ships carry? So Drury estimates that global dry cargo demand, and that's everything from iron ore to washing machines, everything in between, that grew at an average rate of about 4.2% per year for the period shown in that graph, and specifically at about 2% for 2018. So dry cargo, in total, 2% growth over 2018. Some differences within that. You can see container cargo grew faster than bulk cargo. I shouldn't think that's a surprise to anyone. You know, the stuffing of containers with any sort of breakbulk cargo has been, I've stood up here and complained about that for a number of years. So, forecast growth for dry cargo as a whole, and general cargo in particular, is steady over our forecast period, but it's not a straightforward correlation for multipurpose share. That not only relies on the demand for those cargoes, but also the competition from other sectors. So when we look at market share, we make an assessment about how those different bits of cargo are going to be carried, what the modal share is going forward. And we see that we expect that market share to improve very slightly over 2019, and then to stabilise over the next couple of years at about 1% growth. Most of that is due to the increase in absolute volumes, as opposed to market share coming back to this fleet. That isn't likely to happen, we don't believe. I'll come back to that competition in a minute. So pressures on the supply. Obviously, the main pressure on that supply-demand balance is the competition for cargo. Breakbulk and project cargo is not exclusive to the multipurpose and heavy lift fleet. You can put it on a container. You can put it on a small handy bulk carrier if you're talking steel pipes. So those are the fortunes of those other sectors have a increasing influence on the fortunes for the multipurpose and heavy. Oh, and there's Ro-Ro as well. I forgot about that. There's Ro-Ro as well. So you can put that cargo onto a variety of ships. So this graph shows our estimates for modal share for multipurpose and heavy lift vessels with respect to mainly general cargo and bulk cargo. And you can see it dips slightly in 2018, but we expect it to improve. Again, it's fairly minor increments, those improvements, but we do expect an improvement this year. We've already started seeing that, and into 2020. Other pressures on demand include flagging world trade. At Drury, we use the IMF's numbers for global GDP. Global GDP is a main but it's a main driver for this sector, not only because of the impact on investment potential and therefore project cargo, but also on the confidence levels within the market. So the latest forecasts for global GDP over 2019 have been significantly revised. Start of the year, it was about 3.5%. They were revised down to 3.2% in July, and we fully expect that number to have decreased again by the end of the year. So you can see a decrease over 2019 and then into 2020-21. The point was made yesterday. Oh, have I gone? Oh no, I'm still there. The point was made yesterday that we're not talking recession. We're definitely not talking recession. It's still growth. It's just much weaker growth than might previously have been expected, okay? So we're still talking almost 3% growth in global GDP going forward over the next 2 years. Continued trade tensions. Obviously, the tariff war is a huge impact on the maritime sector as a whole. Multipurpose and heavy lift, a little bit less so, but because of that competition from the competing fleets, obviously anything that badly affects the container market is going to affect this sector going forward. So in my report, we look at a base case of, continued disruption in the trade wars, but positive drivers around renewables and Breakbulk. I've got the wrong glasses on. I can't actually read that slide. Anyway, that's my base case. It's my base case. But I've also looked at a high and a low case to sort of frame those expectations. The low case is an increased trade tension, increasing uncertainty, weakening global economy, and then the opposite end of the scale, improved trade relations and government stimulus and increasing global economy. But we've also suggested that the likelihood of that high case is increasingly less probable. So that's what the vertical arrow there is all about. Horizontal arrow there is all about. We're fairly confident about our base case scenario. We're quite happy about all the drivers that we've put into that, but we do accept that worst case scenario is slightly more likely the longer everything goes on. Another big driver in this sector that we really have to look at is the price of crude oil. That's the grey line in the middle there. In spite of a surge in prices at the beginning of the year, the prices have fallen consistently over the last 6 months, and Drury's expectation is they will rest well below $60 a barrel by the end of the year and going forward into 2020-21. The thing about the price of crude oil is it tends to drive investor confidence, especially in the sectors that are reliant on project cargo. $60 a barrel isn't quite at that level to drive that confidence even further. One of the other questions in any outlook scenario at the minute, we've got to look at IMO 2020. I've stood on this platform for a couple of years and talked about, is it going to be scrubbers? Is it going to be low sulfur fuel? Very, very small part of this fleet is investing in scrubbers. Most of the carriers are looking at increased fuel costs. Latest estimates suggest that low sulfur fuel is going to come in at about $300 a tonne above what the older grade fuel that they're currently using is. Inevitably, that's going to be a cost for the market to bear, whether that's in bunker fuel surcharges. I know a number of the container carriers have already talked about those, or whether it's increased freight costs. But it's a cost to the whole market, that low sulfur fuel. So how do those different pressures affect our demand prospects? So we look at effective demand, and when I talk about effective demand, it's a demand where we've taken into account the different competitors, we've taken into account the modal share, and again, we look at it for a lower base and a high case scenario. But for that base case, we're expecting demand to grow at about an average 2% per year to end 2021. And again, as I said before, that's largely driven by the increases in global trade as opposed to any movement in modal share. So in my report, I do forecast rates and asset prices, but I've learnt my lesson at standing up on this platform and giving you all numbers, so I'd much rather give you a picture, especially an index. I've been talking about freight indices for this sector for a number of years, and if there are any shippers out there that I haven't talked to about it, please swap a card with me. I promise I won't bore you silly here, but I'd like to be able to do that next week when you're back there again. But this index looks at a series of time charter rates, period hire rates, for a variety of vessels, and it's data that we get from a number of brokers. And we look at those rates and we make assessments based on the age of the ship and the crane lift of the ship. So there's a little bit of weighting in there. And I don't think that picture is a surprise to anyone, really. Rates have dropped a little bit over the first half of 2019. They are improving now, but overall 2019 is going to be fairly flat compared to 2018. Going forward, again, with those improvements in demand, we're looking at a possible 1 to 2% increase in freight rates. Some of that will be to take into account the increased costs going forward. There's a potential for that to improve if that huge level of overtonnaging that you saw in the first couple of slides that I've put on, if we do see an increased demolition and a reduction in supply, those rates could carry on. If we don't, and if we see a drop in cargo demand because the global economy weakens, then those rates will drop. But there is there's definitely potential for those rates to improve slightly over the next couple of years. So just a few thoughts about challenges and opportunities, mainly to get you thinking for questions for myself and the panel going in the next session. We're expecting rates to strengthen, weaker levels, slower demand growth, but still rates to strengthen. We're expecting increasing operating costs due to the IMO regulations. The ongoing tariff war is likely to weaken demand going forward and increase competition for cargo in particular. Our fleet is still a composite of two very different parts. So all the growth is still in the project carrier section, and the simpler multipurpose fleet is contracting. And a final thought, just for some time now, ship vetting hasn't been about whether the ship is blacklisted or seaworthy. It's much more about, is she going to be allowed to dock if the port dues haven't been paid, or if your cargo has a lien on it. So that financial vetting and robust due diligence is still increasingly more important in this sector, I think, especially with the weaker market and the different challenges going forward. That's me, that's us, that's Drury. Thank you very much for your attention, and we'll do questions. Are we going to do questions in the panel or questions? I'm getting a nod from the back. I think we're going to do questions in the panel, so yeah, please, Dennis, hold that thought. Okay. Thank you.